Look, I need you to pay very close attention to what I'm about to show you, because what's happening right now in the gold and silver markets is something most people won't understand until it's too late. The gold-to-silver ratio just hit a level that historically has preceded some of the most explosive moves in precious metals we've ever seen. And if you understand what this ratio is telling us, you're going to be positioned ahead of 99% of investors out there. Let me start by explaining what this ratio actually means, because this isn't some obscure technical indicator that only matters to traders. This is a fundamental relationship that's been tracked for literally thousands of years. The gold-to-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, as I'm recording this, that ratio is sitting at around 88 to 1. That means it takes 88 ounces of silver to buy a single ounce of gold. Now, you might be thinking, okay, so what? Why does that matter? And that's exactly the question we need to answer, because this number is screaming something that most investors are completely missing. Here's the thing. Throughout history, this ratio has averaged somewhere between 15 to 1 and 50 to 1. In ancient Rome, it was fixed at 12 to 1. For most of human civilization, the ratio stayed relatively stable because both metals were used as money, and their relative values reflected their relative scarcity in the Earth's crust, which is roughly 17 to 1. But in modern times, especially since we went off the gold standard in 1971, this ratio has become incredibly volatile. And every single time it spiked to extreme levels like we're seeing now, what followed was a massive correction that made early investors in silver absolutely fortunes. Let me give you some specific examples, because this isn't theory. In 1991, the ratio hit 100 to 1. Silver was trading at around $3 an ounce, while gold was at 300. Everyone thought silver was dead. Industrial demand was soft, investment demand was non-existent, and the narrative was that silver was just a relic of the past. But then, something happened. Over the next decade, silver outperformed gold by a massive margin. By 2011, silver had rocketed to nearly $50 an ounce, while gold went to $1,900. The ratio compressed all the way down to 31 to 1. If you had bought silver when everyone else was ignoring it, when the ratio was screaming that it was undervalued, you would have made over 1,500% on your investment. Fast forward to 2020. In March of that year, during the COVID panic, the ratio exploded to 125 to 1. It was the highest level in recorded modern history. Silver crashed to under $12 an ounce, while gold was holding steady around $2,000. The fear in the market was palpable. People were liquidating everything, including silver, to raise cash. But what happened next? Within just 5 months, silver doubled to over $28. The ratio collapsed back down to 70 to 1. Anyone who understood what that extreme ratio was signaling made extraordinary returns in a very short period of time. Now, here we are again. The ratio is sitting at 88 to 1, which is well above the historical average and approaching levels that have consistently marked major turning points. But here's what makes this time different, and why I believe what's coming could be even more dramatic than what we saw in 2020 or 2011. The fundamental drivers behind both gold and silver have completely changed. We're not just looking at a technical reversion to the mean. We're looking at a perfect storm of supply constraints, exploding industrial demand, monetary policy chaos, and a global shift away from dollar dominance that's creating conditions we haven't seen in 50 years. Let's start with supply, because this is where the story gets really interesting. Silver production peaked in 2016 at around 900 million ounces per year. Since then, it's been declining. We're now producing less silver than we were a decade ago, even though demand has been skyrocketing. Why? Because silver isn't primarily mined for silver. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. When those base metal prices are low, or when mines shut down for economic or political reasons, silver supply gets squeezed. And that's exactly what's been happening. But here's where it gets even more critical. The above-ground stockpiles of silver that used to act as a buffer are disappearing. For decades, there were massive government stockpiles of silver left over from when it was used in coinage. The U.S. government had billions of ounces. Those are gone. They were sold off years ago. China had huge stockpiles. They've been drawing them down aggressively. The silver that's available today is what's being mined today, and it's not enough to meet demand. We're running a structural deficit in the silver market of over 200 million ounces per year. That means demand exceeds supply by more than 20%. And that deficit is growing. Now let's talk about demand, because this is where the narrative completely shifts. Silver isn't just a monetary metal anymore. It's become absolutely critical to the modern economy in ways that gold simply isn't. Solar panels require silver. Every single panel uses about 20 grams of silver because it's the most conductive, most reflective material we have. And solar installations are exploding globally. We're talking about a 40% increase in solar demand year over year. Electric vehicles use silver. The average EV uses about 25 to 50 grams of silver in its electrical systems. 5G infrastructure uses silver. Every 5G base station requires significantly more silver than 4G. We're building out millions of these stations worldwide. And here's the kicker. There's no substitute for silver in most of these applications. Engineers have tried. They've looked at copper, at aluminum, at various alloys. But nothing performs like silver. It has the highest electrical conductivity of any element. It has the highest thermal conductivity. It's the most reflective. When you need maximum efficiency in a solar panel or an electrical system, you use silver. Period. So as we transition to this green energy economy, as we electrify everything, as we build out this digital infrastructure, the demand for silver is becoming inelastic. It's not optional. It's required. Meanwhile, what's happening with gold? Gold demand is also surging, but for completely different reasons. Central banks are buying gold at a pace we haven't seen since 1967. In 2022, central banks bought over 1,100 tons of gold. In 2023, they bought another 1,000 tons. These aren't small purchases by minor countries. We're talking about China, Russia, India, Turkey, Poland. Major economies are aggressively accumulating gold and moving away from dollar reserves. Why? Because they see what's coming. They see the unsustainable debt levels in the West. They see the weaponization of the dollar through sanctions. They see the BRICS nations working on alternative payment systems. And they're preparing for a world where the dollar isn't the undisputed reserve currency. But here's the critical point. When central banks buy gold, they're not buying silver. Gold is the monetary reserve asset. Silver is the industrial metal that also has monetary properties. So gold is being accumulated and taken off the market by entities that never sell. Central banks don't trade. They accumulate. That gold is going into vaults, and it's staying there. This creates persistent demand that supports gold prices. But it also means that the gold-to-silver ratio is being artificially elevated, because gold has this additional source of demand that silver doesn't have in the same way. Now, you might be wondering, if silver is so critical and supply is so tight, why isn't the price higher? Why is the ratio still so elevated? And this is where we need to talk about the paper markets. Because what happens on the COMEX and in the futures markets often has very little to do with physical supply and demand. The silver market is one of the most manipulated markets in the world. I'm not talking conspiracy theory here. Banks have been fined hundreds of millions of dollars for spoofing and manipulating silver prices. This is documented fact. JP Morgan paid nearly $1 billion in fines for precious metals manipulation. The way it works is this. The vast majority of silver trading happens in paper contracts, not physical metal. On the COMEX, you can sell silver you don't have. You can create unlimited paper supply. And when large banks want to suppress prices, they dump massive quantities of paper contracts onto the market during low liquidity hours. This drives the price down, triggers stop losses, creates panic selling, and allows them to cover their short positions at lower prices. It's a game that's been played for decades. But here's what's changing. The physical market is starting to disconnect from the paper market. We're seeing massive withdrawals from COMEX silver inventories. Registered silver, which is the metal available for delivery, has dropped to critically low levels. We're talking about less than 50 million ounces of registered silver backing a market where open interest represents claims on over 1 billion ounces. That's a ratio of 20 to 1. For every ounce of physical silver available, there are 20 paper claims. What happens when people start standing for delivery? What happens when the industrial users who actually need physical silver can't get it from the paper market? You get a squeeze. You get a situation where the paper price becomes irrelevant because there's no metal available at that price. And we're already seeing signs of this. Premiums on physical silver have been elevated for months. When you go to buy silver coins or bars, you're paying 20%, 30%, sometimes 40% over the spot price. That premium is telling you that the real price of silver, the price at which physical metal actually changes hands, is significantly higher than what the COMEX is showing. This is exactly what happened before the 2011 run. Premiums started expanding, physical became hard to source, and then the paper price had to catch up to reality. Let me paint you a picture of what I think is about to happen, because all of these factors are converging at the same time. We have a Federal Reserve that's trapped. Inflation is proving to be far more persistent than they claimed it would be. They told us it was transitory. It wasn't. They've raised rates aggressively, but they can't keep them high forever because the government is paying over $1 trillion a year just in interest on the debt. At some point, they're going to have to pivot back to easing. They're going to have to start cutting rates and potentially even restart quantitative easing. When that happens, real interest rates go negative again, and precious metals explode. We have a geopolitical situation that's deteriorating rapidly. The war in Ukraine, tensions with China over Taiwan, instability in the Middle East, the fracturing of the global order. Every one of these situations drives safe haven demand for gold and silver. We have a banking system that's far more fragile than most people realize. We saw what happened with Silicon Valley Bank in the regional banking crisis. That wasn't resolved. It was papered over with emergency lending facilities. The underlying problems of duration mismatch and unrealized losses on bond portfolios are still there. When confidence in the banking system cracks again, people flee to hard assets. And we have this massive industrial demand for silver that's only going to accelerate. The green energy transition isn't slowing down, it's speeding up. Governments around the world have committed trillions of dollars to electrification and renewable energy. Every single one of those dollars translates into silver demand. The solar industry alone is projected to consume over 200 million ounces of silver per year by 2030. That's more than 20% of total annual production going to just one sector. So when you put all of this together, what you have is a setup where silver is fundamentally undervalued relative to gold. The ratio at 88:1 is telling you that silver is cheap. History tells you that when the ratio gets this elevated, it corrects violently. And the fundamental drivers tell you that this correction could be more dramatic than anything we've seen before, because we've never had this combination of monetary chaos, geopolitical instability, and industrial demand all hitting at the same time. Now, let me talk about what this means for you practically. Because understanding the setup is one thing, but positioning yourself to benefit from it is another. If you believe, as I do, that the gold to silver ratio is going to compress, there are several ways to play it. The most straightforward is simply to own more silver relative to gold. If you're building a precious metals position, you might allocate a higher percentage to silver than you would based on the current ratio. Some investors are going 50-50 gold and silver by dollar value, which means they're holding far more ounces of silver. Others are going even more aggressive, 70% or 80% silver. The logic is simple. If gold goes up 50% and silver goes up 100% because the ratio compresses, you make more money with a higher silver allocation. But you also take on more volatility. Silver is a smaller market, it's more volatile, and it can move violently in both directions. You need to be comfortable with that volatility. You need to have a long enough time horizon that you're not forced to sell during a temporary dip. Because make no mistake, the path from here to a normalized ratio isn't going to be a straight line. There will be shakeouts. There will be moments where it looks like the trade isn't working. That's when weak hands get flushed out and strong hands accumulate more. Another consideration is the form in which you hold silver. Physical silver, coins and bars, gives you direct ownership with no counterparty risk. You hold it, you own it. Nobody can take it from you. But it comes with storage considerations and those premiums I mentioned earlier. Silver ETFs like SLV give you exposure without the storage hassle, but you're trusting that the fund actually has the silver it claims to have, and you can't take delivery. Mining stocks give you leveraged exposure to silver prices, but you're also taking on company-specific risk, management risk, and jurisdictional risk. Each approach has trade-offs. Quick aside here because this is relevant. If you're sitting on a significant amount in retirement accounts, $100,000 or more, and you're thinking about how to get precious metals exposure in a tax-advantaged way, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can actually hold physical gold and silver inside your retirement account without triggering taxes or penalties. It's worth checking out if that's your situation, because a lot of people don't realize this is even an option. Anyway, back to where I think this ratio is headed. The historical average of the gold to silver ratio over the past 30 years is around 60 to 1. If we simply revert to that average from the current 88 to 1, and gold stays flat, silver needs to rise about 47%. If gold goes up 20% and the ratio compresses to 60 to 1, silver needs to rise 76%. But here's where it gets really interesting. In bull markets for precious metals, the ratio doesn't just revert to the average, it overshoots dramatically to the downside. In 2011, it hit 31 to 1. In 1980, it briefly touched 17 to 1. If we get a real mania in silver, driven by a combination of investment demand and industrial shortage, we could see the ratio compress to 40 to 1 or even 30 to 1. Let's run those numbers. If gold is at $2,800 an ounce, which is only about 10% above where we are now, and the ratio goes to 40 to 1, silver would be at $70 an ounce. That's a triple from current levels. If the ratio goes to 30 to 1, silver would be at $93 an ounce. That's nearly a quadruple. And if gold itself rallies to $3,500 or $4,000, which many analysts believe is likely given the monetary and geopolitical backdrop, and the ratio compresses, you're looking at silver potentially going to $100 or higher. These aren't pie-in-the-sky numbers. These are mathematical outcomes based on historical ratio compressions and modest assumptions about gold prices. But let me be clear about something. This isn't a get-rich-quick scheme. This is a strategic position based on fundamental analysis and historical patterns. The timing of when this ratio compression happens is uncertain. It could start next month. It could take another year or two. What I'm confident about is that the setup is there. The fundamentals support it. The technicals support it. And history tells us that extreme ratios don't persist indefinitely. They correct. And when they correct, the moves are fast and dramatic. One of the things I watch closely is the behavior of the smart money. What are the major mining companies doing? What are the sovereign wealth funds doing? What are the billionaire investors doing? And what I'm seeing is accumulation. Mining companies are holding back production, waiting for higher prices. Billionaires like Eric Sprott have been buying massive amounts of physical silver and silver mining stocks. Countries like India and China, which have enormous populations and growing middle classes, are seeing surging retail demand for silver. These aren't dumb players. They're positioning for what they see coming. I also watch the short interest in silver. The commercial traders on the COMEX, primarily the big banks, have historically been short silver. They've used that short position to manage their hedging operations and, let's be honest, to manipulate prices lower. But recently, we've seen that short position start to decline. They're covering. They're reducing their exposure. Why would they do that unless they thought prices were going higher? These are the most sophisticated traders in the world, with access to information and analysis that we don't have. When they change their positioning, it's worth paying attention. Another factor that's often overlooked is the psychological aspect of the gold to silver ratio. Most retail investors don't even know it exists. They buy gold because it's gold. They buy silver because it's cheaper per ounce and they can accumulate more of it. But as awareness of the ratio spreads, as more people understand that silver is historically cheap relative to gold, you get a self-reinforcing cycle. People start buying silver specifically because of the ratio. That buying pressure drives silver prices up, which compresses the ratio, which attracts more attention, which brings in more buyers. It's a feedback loop that can accelerate very quickly once it starts. We saw this in 2010 and 2011. The ratio started compressing, people noticed, and suddenly, everyone wanted silver. Coin dealers couldn't keep inventory. Premiums exploded. The US Mint had to ration Silver Eagles because they couldn't produce them fast enough. That kind of frenzy can develop seemingly overnight when the conditions are right. And the conditions right now are arguably better than they were in 2011 because the fundamental supply-demand imbalance is worse, the monetary situation is worse, and the geopolitical situation is worse. Let me also address the bear case, because it's important to consider both sides. The argument against silver is that if we go into a severe recession or deflationary collapse, industrial demand for silver will crater. Solar installations will slow down, EV production will decline, and the price will fall. That's a legitimate concern. Silver is more economically sensitive than gold because of its industrial uses. However, I would argue that in a severe economic crisis, the monetary demand for silver would more than offset the decline in industrial demand. People would be fleeing to hard assets. The paper currency system would be under stress, and silver, as the poor man's gold, would see massive retail buying. We actually saw this play out in 2008. Yes, silver initially crashed along with everything else when the financial crisis hit. It went from $20 down to $9 in a matter of months. But then what happened? It bottomed before the stock market did, and it rallied all the way to $50 over the next 3 years while the economy was still struggling. Why? Because the Fed's response to the crisis was to print trillions of dollars. That money printing debased the currency and drove people into hard assets. The same thing would happen in the next crisis. The Fed's response would be to print even more aggressively than they did in 2008, and precious metals would be the beneficiaries. There's also the argument that technology will find a substitute for silver in industrial applications. Maybe some new material will be developed that's cheaper and works just as well. It's possible. But it hasn't happened yet, despite decades of research. And even if a substitute is found, it takes years to implement at scale. The solar panels being installed today, the EVs being built today, they're using silver. That demand is locked in for the foreseeable future. By the time any substitute could make a meaningful dent in silver demand, we'll likely have already seen the ratio compression play out. What I find most compelling about this setup is that you don't need everything to go right for it to work. You don't need a currency collapse. You don't need a financial crisis. You don't even need gold to go to $5,000. All you need is for the ratio to revert toward its historical average, which it has done repeatedly throughout history. That's a high probability outcome based on mean reversion alone. Everything else, the supply deficit, the industrial demand, the monetary chaos, the geopolitical instability, those are all tailwinds that could make the move even more dramatic. But the core thesis is simply that silver is cheap relative to gold, and that cheapness won't persist forever. I want you to think about this in terms of risk-reward. What's the downside? Silver could go lower in the short term. It could test $20 or even $18 if we get a strong dollar rally or a deflationary scare. But the long-term downside is limited because at some point, mines shut down when prices get too low, supply contracts, and prices stabilize. The upside, on the other hand, is potentially several 100% if we get a ratio compression combined with a bull market in precious metals. That's an asymmetric bet. The potential gain far exceeds the potential loss. This is why I've been accumulating silver personally. Not as a speculation, but as a strategic allocation within a broader portfolio. I view it as insurance against monetary instability, as a hedge against inflation, and as a value play based on the ratio. If I'm wrong and silver just sits here for the next few years, I haven't lost anything because I'm holding physical metal that will always have value. But if I'm right, and we see the kind of move that history suggests is coming, the returns could be life-changing. Let me leave you with this thought. The gold-to-silver ratio is one of the oldest financial metrics in human history. It's been tracked for thousands of years across multiple civilizations. And throughout all of that history, extreme ratios have always corrected. Always. There's never been a time when the ratio stayed at 80 or 90 or 100 to 1 indefinitely. It always reverts. The only question is when and how fast. Given everything we've discussed, the supply constraints, the demand explosion, the monetary backdrop, the geopolitical situation, I believe that reversion is coming sooner rather than later. And I believe it's going to be more dramatic than most people expect. So pay attention to this ratio. Watch it. Understand what it's telling you, because right now, it's screaming that silver is undervalued. And if history is any guide, that's an opportunity that won't last forever. The smart money is already positioning. The question is, will you be ready when the ratio starts to compress? Because when it does, the move is going to be fast, it's going to be violent, and it's going to create enormous wealth for those who understood what was happening and positioned themselves accordingly. This is your warning. This is your opportunity. What you do with it is up to you.